Alright, so today we are going to talk about a very special bond. Yes, bond, the boring, safe investment your dad tells you to buy. But the bond that we are going to talk about, it can legally turn into a stock or just vanish to absolute zero. There is no fraud, no scam, no fine print tick anyone's hiding. It's completely legal, completely intentional design. And it's called CoCo, the contingent convertible bond. And the banks didn't stumble into it by accident, they basically invented it on purpose with regulators cheering them on. By the end of this video, you'll understand exactly why the safe sounding investment in your portfolio might actually have a self destruct button built right into it, and why some smart investors in the world are actually buying it. Let's get into it, right? So, when you're buying a bond, what are your expectations? First, you're expecting a regular fixed interest payments, and at the time of maturity, you are expecting your principal back, right? By the interest payment, you are actually getting regular income, you are getting predictable returns, and this is the entire reason, the main reason why people actually buy bonds. And at the end of the maturity, be it any 10 years, 5 years, 20 years, 30 years, you'll actually get the initial principal back. So a bond is basically a promise in simple terms. It's simple, it's predictable, it's safe, right? But now imagine that particular bond suddenly stops being a bond. It's not a bond anymore, right? What can happen? The twist is that that particular bond can actually turn into shares, right? You actually become a owner. The bond, when converted to a stock, you are no longer a lender, right? You were first a lender. The company was paying you interest in forms of coupon payments, right? And now, because that bond no longer exists, you are now a shareholder. So you are now the partial owner of that bank. Or this is a good scenario, this was much better, but the worst thing is that particular bond could lose most of its value. In some cases, the bond can be written down to absolute zero, and your investment basically vanishes into thin air. But again, why would anyone buy an instrument that is potentially designed to disappear? Right? Let's say you're buying a bond for 5 years, and after 2 years, there might be a situation that first of all that bond is no longer a bond, but you are a shareholder of that company, right? It might not match your risk profile, right? Or that bond could actually become zero, lose its entire value. So, to basically understand why investors are still investing in these types of bond, we have to understand about the problem, right? And why it is basically why regulators are so worried about it, right? First about we are going to understand about banks and other businesses, right? See, when we are talking about two companies. First, we have a normal company, a normal business. What happens, right? If this normal company fails, the shareholders, all the equity shareholders, might actually lose all their investments, right? But this is investment. This is the risk that you take, right? What happens? The shareholders could actually lose their investments. Whatever money would come from liquidation or etc. etc. Creditors would sit together and negotiate and talk about their recovery because they need to be paid first, right? The business eventually closes or basically restructures, right? And talking about the economy, there's nothing that is changed here. One small company or business has shut down. It no longer is there, right? But when we're talking about a large bank here, what happens is, first of all, it's a large bank. Be it a small bank as well, the situation is not going to be different. But when a large bank is falling, what will happen? First of all, the depositors would panic and run. See, depositors is the first step of the primary goal of bank, that is money creation, and depositor is the first step. And what depositors running to the bank and panicking is called bank run, right? They are all running towards the bank to cash out and liquidate their savings, right? And it has a ripple effect on the economy, right? Credit starts freezing across the economy. Businesses who basically, there are additional businesses maybe with fewer cash flows, maybe with cyclic cash flows, who actually depend on lending to make sure they can at least pay their staff out, right? So business won't be able to borrow, and they won't be able to pay their employees. So what happens? A bank actually failed, and a person, a worker working in a unrelated factory, is actually the one who is being affected. So in this way, the entire economy is being affected. That particular person who is not getting his salary has nothing to do with the bank, right? See how the ripple effect goes. So banks are basically not some ordinary companies. When a large bank actually fails, the ripple effect can actually destroy jobs, saving, economic stability far beyond the bank's own walls. And this is why regulators obsess over bank capital, right? So now let's, okay, bank could fail, right? Now let's narrow down our problem. If a bank is in trouble, who would absorb the losses? See, when we look at the 2008 financial crisis, in that particular situation, the answer was taxpayers. People who have actually nothing to do with any of the banks involved, any of the mortgage SVPs included, nothing. Taxpayers were actually absorbing the losses. How? Because of government bailouts. Government came into the situation, bailed out the companies in order for them to survive, or maybe just make sure that all the loans are figured out. But taxpayer in the first place has nothing to do about the entire crisis. Right, it's the investors who are taking all the risk. It's the stakeholders of that particular company who are taking all the risks. Right. So regulators basically wanted a new answer. This was a very troubling situation for the regulators as well. This is fairly something that is happening to the wrong people. It is affecting the wrong set of people, right? So they wanted that private investors should actually absorb losses first, and most importantly, it should happen automatically. There should be no need for a vote in the parliament, right? They don't have time for that. The bank is struggling, it is affecting the economy all throughout, right? So they don't want a vote on it, they don't want the decisions to change, they just want it to happen, and happen automatically, right? So what happened in the old system, right? And how was laws absorbed? See, with we are I know we are in this channel, at least we are familiar with this type of structure now, right? We have covered this type of structure in a lot of videos now. So what happens here? The depositors, who are basically the most senior, see, banks are really careful about the depositors, right? So basically this is the least risky one, right? So they get return less as well, right? These deposits are basically your saving account, right? Things like this. Then we have the debt and bond, a fairly high amount of risk as compared to the deposit, so they get a little bit more return. But equity, which are basically the first to absorb losses, right? So whenever the losses hit, equity is first hit with it, and then debt, and then the deposits, right? So because the highest risk is associated with equity, the return is often the highest as well, right? Shareholders absorb losses first, and that's how capitalism works for normal companies. But what happens when equity is wiped out and losses still continue? Let's see an example. Let's say the bank has assets worth 100 rupees and the liabilities in accordance to the assets has the bank has 95 and the rest is equity of 5 rupees by the shareholders. Let's say in an adverse situation the asset value falls down to 92 rupees. Now the actual loss is of 8 rupees. Right, now equity was just 5 rupees and the loss is 8 rupees. Equity is wiped out to 0, but the remaining loss is still 3 rupees. Now the real question is, who would absorb the next 3 rupees of losses? In the old system, what was happening, the government came in, stepped in with a bailout. Bailout was actually funded through the tax that was collected from the taxpayers, the general public. And regulators hated this. They wanted that the private capital should be the one to absorb the losses and that should happen automatically. Right? This has nothing to do with the general public. Basically, in theoretically, I would say, in this particular situation, I would say theoretically, what taxpayers are actually giving taxes for is to make sure that they are getting proper infrastructure, roads, equality, everything, right? But again, so theoretically we are talking about it, but they definitely are not giving out money in form of taxes to make sure that other companies or bank are surviving off it, right? They are paying that for infrastructure development. Now, what was the regulator's idea? Right? They invented contingent convertible bonds. Contingent when the emergency strikes, and they are convertible to whom? Maybe shares, right? And then we have the bonds. So those are called CoCos, right? So what basically regulators wanted was more of the bank capital, in a way that bank should actually hold more of the loss absorbing resources, and that too in their own balance sheet. They should not be they should not stand down and wait for the government to come in with their own plan. Their balance sheet should be filled with, or maybe increase the hold of more loss absorbing resources, right? The bailouts should be fewer, right? So basic purpose was to protect the taxpayer, make private investors bear the cost of bank failures, right? And this was one of the most important points by them. They don't want to wait for politicians or the negotiations to happen. The losses should be absorbed automatically whenever it is triggered. So the big idea was that if the banks issued bonds that automatically absorb losses when the bank becomes weak. So in the good times, what will happen? It will behave like a normal debt, right? Everything is going good, right? Bank would pay higher interest rate, right? Investors would receive a steady income, and no conversion is triggered. See, come back to this point. When we are talking about CoCos in this particular situation, what is happening? It is different from the normal bond, right? You have an everlasting risk on your head that this bond that I'm holding as a safe investment, it could directly be converted into share or become absolutely zero in case of panics. So the investors, if they want to actually invest in that particular bond, would actually demand a bit higher yield or return from the issuer, right? So in good times there is no conversion that is actually triggered, and investors actually get a more steady stable income. But in bad times, what will happen is the regulators wanted that it should automatically convert into equity, right? Or maybe the losses are written down. See what will happen, even if the investment is brought down to zero, it is the investment of the investors who are actually willing to take the risk, and not the taxpayer who just wanted something like a good infrastructure, right? So basically what was happening, the investors who were actually there to bear the risk, they were not being affected, right? They were not being affected, but the taxpayer was affected, right? So losses in this scenario should be absorbed by the investors, and the bank capital ultimately becomes protected. Right? A CoCo behaves like a debt during a good times and equity during the bad times. So how basically this conversion works? So let's imagine we are talking about a normal bond. What happens in that? Then the investment is 100 rupees. You'll get a coupon of 5%, and your annual coupon payment is 5 rupees. It is safe, predictable, and but with a lower yield. So with CoCo bonds, what happened? Let's say the investment is 100 rupees. The interest rate is 9%. You get an annual income of 9 rupees. That actually is 5 rupees more than, mostly double, right? Double than the normal bond. The higher yield is for the higher risk. See, investors are taking on the conversion risk, the risk that their bonds could actually turn into stocks or maybe disappear. So that's why they're getting more than double or maybe more 5 rupees per year, per 100 rupees, right? So when will trigger happen is when the bank capital ratio would fall below a predetermined. See, this is very important. This is predetermined threshold, right? So either the conversion or their written down would be activated in that particular way, right? So for this particular trigger risk, for this conversion risk, the CoCo bonds get a higher coupon payments, right? So what happens when before the trigger, you're actually the lender, right? Bank owes you 100 rupees plus the interest in form of coupon payments. You have a contractual claim. But after the trigger, you actually become the owner of that particular bank. Your 100 rupees becomes the shares, the face value of the bond, right? And now you have a share in the bank's fate. Either good, then good. If not, then see, the investor is no longer a lender. They become an owner, sharing both the upside as well as the downside. This is the contingent part of the CoCo bonds. Conversion only happens if the bank hits troubles, right? Now, why investors buy this? The missing middle ground, high yield versus higher risk. See, when we're talking about government bonds, which are actually safe havens, right? They're considered safe havens, right? So they actually get a bond, the interest rate of 4%, whereas corporate bonds give maybe a high yield of 7%. But CoCo bonds, you are getting 8 to 10 plus percent, right? Many investors believe that the banks is unlikely to trigger conversion. See, this is not something that is happening on everyday basis. You can't expect a bank to fall and trigger to set off every single year, or maybe 5 years is also a time period in which you won't expect a bank to face troubles, right? So this was the main belief of the people who were actually investing in CoCo bonds. So they believe that of course it's unlikely to trigger conversion, so they benefit from collecting a higher interest rate. It is always there is a risk that is associated with it, but still the higher yields are existing because risk exists. There is no free lunch, absolutely. But let's talk and now compare theory versus reality, right? So what happens initially? The bank starts to weaken. The CoCo bonds convert to equity. Your capital basically increases. Eventually the bank stabilizes, and in theory it is sounding so elegant, right? The instrument does exactly what it was designed for, that is to absorb the losses automatically and protect the bank, avoid taxpayer bailout. But see, markets are not at all mechanical. They don't care about your fancy spreadsheets, right? They are actually driven by the human psychology, the panic, and the interconnected fears throughout the economy, right? So in reality, the chain reaction is quite messy, right? Investor starts to panic like anything, right? This is always the first reaction of the investors, right? Which eventually triggers the collapse of the bond prices. And when that happens, the confidence actually falls. Which, see, when the confidence is falling, the funding cost is rising. So even the professionals actually disagree. There's a pretty big debate that how effective actually these cocos are, because when this crisis hit and it is actually severe, the panic is not actually making sense in the way it was supposed to be, right? A financial instrument can work mechanically, obviously, but it can still create an unintended market reaction. Let's talk about the 81 bonds, right? So what happened with the 81 bonds in Credit Suisse was actually pretty weird. See, uh, in 2023, what happened, that Credit Suisse was basically a major global bank, right? It collapsed and absorbed in an emergency rescue. But there was a surprise. That particular shock actually shook the entire cocoa market. And see, what was happening, that the 81 bonds was a type of cocoa bonds which actually suffered a lot of massive losses. Now why? Because people had actually assumed that the traditional hierarchy would hold, which is the equities would first absorb the losses, then the 81 bondholders, and then it would be senior debt, which are protected in line. And that's the order that everyone expected. Now, when reality unfolded, it was something that was totally different, right? The order didn't really pay out the way the textbook said it would, right? And there comes a lesson. The contract terms actually matters enormously. See, finance structure always matters. The fine print in the bond prospectus determines exactly when and how the conversion of the written down would happen. And this was different in 81 bondholders. This was entirely different situations, right? Assumption was being based on a normal bond behavior which went dangerously low. And this case basically became the defining moment for understanding cocos and a warning about reading the terms. So when we're talking about cocoa bonds, they are a hybrid model. They have debt features, right? During normal times, it pays interest, it has a maturity. Usually it could be perpetual bonds as well, right? They are senior to equity in normal times. Talking about the equity features, it can convert into shares, right? And ultimately the bond holder would actually be a participant in the upside or downside, whatever happens to the bank after the trigger, right? The crisis feature basically tells you about that it is designed specifically to activate only in the bad times, which act as a financial shock absorber, right? It is basically like a financial airbag, and most of the times you hope that it never activates. It sits quietly, earning you an extra yield, but it is designed specifically for the bad days and bad days only, and that too to absorb the impact. So it is gonna hit you hard, right? And it happens when everything is failing, right? Maybe your portfolios are red as well, right? So let's, once we have started, so let's talk about everything that could go wrong, right? So when the trigger is activated, conversions happen, right? But the problem is conversion is happening when everything is falling in the terms of crisis. So this conversion is actually hurting you even bad, right? When you least expected, see, you expected, all right, but it happens when you don't want it to happen, right? And that is something that you can't really avoid. That is the game, right? The biggest problem is, see, your bonds would be converted to shares, but what price of shares, right? Shares received may be worth far less than the bonds face value as well. Whatever the market price of that particular share in that particular moment is, that and that only would be converted to. The market panic. See, even without a trigger, prices can crash anytime with the word fear alone. Fear is everywhere, right? And you can only see it when you own the things that expected, right? When we're talking about regulatory interventions, regulators can actually force the write downs, as in case of credit Suzy case, right? They basically force the write downs. Then comes in the contract complexity. See, terms vary widely. The fine print, again the credit Suzy case, fine print actually is the determinant of everything. Right? CoCo bonds in the case of credit Suzy just became a heading. The subheadings were totally different. Right? When we're talking about a liquidity risk, CoCos can essentially become very hard to sell. See, it is risky, right? So you can't expect it to sell quickly without a big price hit, so you would eventually lose value. And the biggest risk is often misunderstanding the instrument itself, right? So what's happening at the micro level is that you are getting a higher yield for a higher risk. At the meso level, the extra capital buffer is actually coming in as a stronger push in time of stress. At the macro environment, the fewer bailouts actually help in making sure that the taxpayer money is not under burden but is actually used for something useful. So COCOs were basically designed to solve a system level problem by changing the incentives at the instrument level only. And by this way they could be triggered automatically as well. Right. So let's draw the complete picture once again, right? Just to clear all our thoughts in a more justified manner. So you get the bonds at high yield. Whenever the banks lend tend to be in trouble, the trigger is activated. You either get converted to shares or the bonds are written down and the loss is absorbed. The COCO exists because the regulators wanted someone to absorb the losses before the taxpayer did. Right? They never wanted the taxpayer to be the first safe haven. Right? So COCOs are not at all safe bonds and they're not ordinary stocks either. They're basically a crisis instrument which are designed for extraordinary situation. In good times they work well and look like that, but in bad times they become something that is entirely different. Right. So with this we can understand that modern banking doesn't really just manage money, they are basically designing and coming up with instruments to absorb the losses. Right. So thank you so much, and if you have any doubt, I love for you to give your feedback or your inputs or your questions in the comment section, and I'll definitely reply them. Right.